Well, hey there, everyone. Happy Friday, April 3rd, 2026, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller. Markets are closed today here for the Good Friday holiday in the U.S. It is a beautifully sunny and gorgeous day here in Redmond, Washington. We're supposed to have really decent weather over the weekend, high around 69 degrees Fahrenheit on Sunday for Easter, which would be pretty awesome. Then we get back to cold and rain the day after, but we'll take it. Hope you guys are all doing well, hanging in there, and finding joy and happiness wherever you're at. And thanks so much for tuning in here. Fridays are all mailbag episode with the market closed. We don't have much to recap in terms of the market conditions because there wasn't any trading today in U.S. markets, but we will take a few moments here to focus in on some of the great questions we received through the week. During our daily live stream, you can ask questions live if you tune in. Of course, if you watch the replay on our YouTube channel, you can always drop questions in the comments section on our YouTube channel. So these are all questions we've received from all of you in the last couple of weeks. Keep them coming, by the way, because we love to answer your question in our next mailbag episode coming up this Friday. So just as a quick recap of market conditions, again, no trading today in the U.S. For the Good Friday holiday, but I will tell you that, of course, the week ended up being pretty strong. Friday was the weakest day of Thursday's session was the weakest of all of them, but a weaker open was bought pretty aggressively. And I think that was one of the key stories going into the end of the week. Another key story is the defensive sectors like real estate and consumer staples doing a lot better than you'd expect. If this is a big bullish broad recovery, I would expect some other, cyclical sectors, some growthy sectors at the top of the leaderboard. It's still very much a defense over offense general complexion through the week. This rally this week, though, was enough to put our short-term market trend model back bullish for the major U.S. equity indexes. So we have short-term bearish, short-term bullish, medium-term bearish, long-term bullish, which, to be honest with you, is exactly how the market looks if I would just bring up a weekly chart of the S&P and sort of give my take on those timeframes. That's about what I would say. The question is, does that short-term strength lead into enough sustained broad strength that is able to draw the benchmarks even higher through the month of April? I actually just wrote an article for stockcharts.com addressing some of the key charts to watch to try to make that assessment as the S&P and many stocks are trying to test their 200-day moving averages from below. So if you go to stockcharts.com, it's a free article under the article section. Hopefully you can check that out and you'll see what I'm talking about. All right, let's get to some of the great questions. Again, these came from people like you over the last week or two. And let's get to it. Question number one, during major long-term downtrends, does the Hindenburg Omen continue to fire as the market is dropping as a warning to avoid bear market rallies? I get a lot of questions about the Hindenburg Omen. I seem to be one of the more vocal people when those signals pop up, and that's because in my experience, those Hindenburg Omen signals, I found it's a really good idea to not ignore them. So the short answer to your question is no. The way that the Hindenburg Omen and other things work, there's kind of two different types of indicators, right? And I'm generalizing in a big way, but two kind of generally different, types of indicators. The one type of indicator would be like a MACD or PPO. This is an indicator that's always signaling, right? And what I mean is an indicator like PPO is at any time it's bullish or bearish. When the PPO line or the MACD line crosses up through the red signal line, that's a bullish crossover. That's a buy signal. When the PPO line crosses down through the red signal line, that's a bearish signal. So at any point, if you bring up a stock, it's either bullish or bearish based on the direction of the most recent signal, right? We can look and see most recently, we got a bearish signal in December on the weekly chart of IBM. It remains bearish through the end of this week. And so we're waiting for a bullish crossover. But there are other indicators that are not kind of always of an opinion. They're things that signal a lot less often. And two examples of that, one would be the Copic curve. The Copic curve is an indicator that is really only designed to identify major lows. It is designed to give a signal after a period of market of a market downtrend. So basically the Kopic curve, which is the difference between the 11 and 14 month moving averages, has to go below the 0 level. And then you look for the first month where the slope goes higher, and that's kind of the bullish signal. And so the slope of the Kopic curve going from negative to positive, that's the signal. So with these vertical green lines I've identified over the last 25 years or so, 30 years, every time that has happened, where it's gone negative and then turned positive. And as we can see, it's been a pretty good indication of a new bullish phase. So, is the Kopic curve telling us anything now? Like, it isn't, because we haven't, we're not in a downtrend, right? We're in an uptrend right now. So looking at the Kopic curve in this environment doesn't make a ton of sense, because we're in an uptrend, right? And the Kopic curve is only meaningful to identify a potential low. So you have to be in a downtrend first, right? The opposite is the case for something like the Hindenburg Omen. The Hindenburg Omen is really designed only to identify major tops. So if we're already going down, the Hindenburg Omen doesn't really have a purpose anymore. As a matter of fact, one of the basic premises of the Hindenburg Omen, one of the three factors, is that the New York Composite Index 50-day rate of change has to be above 0. So to even get a signal, the market has to be higher than it was 50 days ago, which means we're in an uptrend. So in a downtrend, which I would argue we're in now, the Hindenburg Omen, it's not even something you look at. Now, are there other techniques that we should be looking at to answer the question you're implying, which is, how do we differentiate between a counter trend rally and the V-bottom beginning of the uptrend? And that's where it's not the Hindenburg Omen, because that's not an indicator that's designed for that. So we need to look elsewhere. So some of the things that I would be looking at, things like, hold on a second here, I went on the wrong chart. I just wanted to bring up the daily chart of the S&P 500, right? So things we look at, moving averages, right? Do we get back above the 200-day moving average? Momentum, does the RSI push above 50 and even 60? Those would be some of the basic things on the chart of the S&P to help us make that assessment. In terms of breadth, do breadth conditions that have turned quite negative get back positive? We're still down around 30% of S&P members above their 50-day. Want to see that above 50%. We're still below 50% of S&P 500 members above their 200-day moving average. We'd want to see that above 50%. So breadth indicators that have been tilting negative, we want to see those tilting more positive. And so that's those are the things I would look for. So short answer is no. Hindenburg Omen, not really meaningful right about now, because it's already given the signal. I think it was a very good signal in January and February, implying that we were at or near a major market peak. I think the deterioration we've seen since then, you could look back and say, yeah, the Hindenburg Omen was a pretty good warning sign that was impending. Do we still use it today? Like, no, and that's why I don't mention it on the show much. It's kind of done its thing. And now we're looking at other indicators, because there are other indicators that help us sort of navigate this next phase. And that's why, honestly, that's why the technical analysis toolkit, particularly the macro toolkit, I don't think you can just look at one indicator. There's a bunch of different things that we look at depending on what's happening in the, what sort of environment we're in. And so that's how the Hindenburg Omen fits into a broader list of, I would say, macro technical disciplines. Next question. The financial market universe is big and complex and overwhelming. Too many instruments to choose from. How should I figure out where to invest? I love that question. That could be an entire weekend long retreat. Maybe that's something we work up, a market misbehavior weekend retreat, where we talk about these sorts of things and talk about putting together an investment plan based on some of the technical and behavioral premises. It's on my someday list. It's not today, but maybe at some point. So keep your eyes open or ears open for that announcement. Maybe sometime we talk about that. So in the meantime, where to point you to? So yeah, right. If you're just getting kind of started with this, if you're just starting to manage a portfolio, if you started to put away a decent retirement account, or have been outsourcing it and you're finally not happy with how the money's been managed, now you're kind of taking control of it. Common question, how do you approach it? So I'll tell you a couple of things. Number one, there are a number of books that have been written to try to help you understand that. A number of them that I would recommend are on my recommended reading list. If you go to marketmisbehavior.com and click on reading list in the upper right, these are some of the books that I would, say make a ton of sense if you're trying to get your head around it. Some of these are more about general investing, which these first three are about cycles and stuff. I would personally get all down here to where it says like trend following and momentum investing strategies. These 3 books for me were pretty valuable because they really describe how to apply technical analysis on a portfolio level and how to think about, all right, I have this nest egg or this pool of assets, this portfolio. How should I be allocating that? How can I use technical analysis, particularly relative strength, which is a consistent feature of all 3 of these books, to to just sort of focus on where the momentum is and make sure that I have a regular process of circling, of unwinding positions that are no longer helping my portfolio and leading into positions that may start to help my portfolio. My own personal approach to investing is really inspired by these 3 books, along with a couple others that I've read over the years. The general idea with this, and another one would be the Ivy portfolio is another good one. Muscular portfolios all kind of have this similar vibe, which is a momentum-based process. Usually has some sort of like a monthly rebalancing process where you analyze market conditions and sort of look at what's working and make sure you rotate into those stronger things. Dual Momentum Investing by Gary Antonacci was one of the first books that I read that helped me get my head around how I wanted to do that on my own portfolio. So that's one thing that I would think about, just sort of that, how to apply technical analysis more on the portfolio level. And again, I mean, they're not recommendations there. I think it's more inspiring you to develop a process to help you make the decisions that you want to do. The other thing I would say is that's one of what you're alluding to is, I think, one of the great benefits of technical analysis, right? A lot of times if people are not technically oriented, you kind of get very laser focused on a particular method of investing, and it's not very sensitive to market conditions. And for me, one of the great benefits of using technical analysis, one of the great benefits of having scans that I schedule to run every day and scans that I schedule to run every week, these are scans that are automated every day that tell me which stocks are making new 3-month highs, which ETFs are making new 3-month highs, which stocks and ETFs are making new 3-month lows. I have weekly routines that run every Friday after the close that go through a big universe of stocks and ETFs and just tell me what's working. Because for me, I've learned, I've developed certain strategies where certain parts of my portfolio I'm going to reallocate based on what comes up in those scans every day or every week. So that's where I would kind of start. I would kind of get going with that. And at the top of that list, the book How to Make Money in Stocks by William O'Neill, one of the best in terms of just helping you understand thinking about a process of stock selection and picking stocks and how to put those together in a portfolio. I hope those inspire you and give you some ideas. And again, you can find that recommended reading list at marketmisbehavior.com and click on reading list in the upper right corner. Third question, how would you approach Enphase from a technical perspective with a price breakout, but its relative strength remained weak? Interesting question. Let's look at it. Enphase Energy. Man, this is a stock we used to talk about a lot more. I'm looking at the weekly chart of Enphase, like back here, like COVID era name. I mean, this is one that was just lighting it up, making a great uptrend. And then it rolled over and it did so well in 2022 when the major benchmarks were just getting absolutely crushed. Here's Enphase Energy making new highs. Talk about a different era. 23, 24, 25. Enphase had down years in each of those years, had a nice spike in the first 6 weeks of the year, but then has given back a lot of those previous gains. So your question is, how would you approach this from a technical perspective? So I'll tell you this. Enphase Energy looked really encouraging right about here. And I vividly remember taking a look at this stock, as it's bouncing off of a November low, strong December, strong January, pushing above the 200-day, and then this big gap higher. And that was in early February. That was their February earnings release. Looked really encouraging. And we've talked a lot about price gaps and, price gaps, predicting when a gap is going to happen and whether it's going to be higher or lower, I think is incredibly difficult. And if you're in that business, I think it's more luck than skill in a lot of ways. And the problem I find with that is if you start being right a couple times, you feel like you have this amazing crystal ball where you're able to predict when stocks are going to gap up. And then one gap down kind of erases that. So it's sort of a wake up call of sorts. That's very difficult. So predicting which way a gap is going to go, I mean, it's kind of like predicting a quarterly earnings result. I mean, you can get it right sometimes. It's incredibly difficult to do consistently. But what we can do is analyze performance after that earnings release. This is something, if you go to my podcast, which you can find on my YouTube channel, I had a podcast interview a couple weeks ago with Alex Cartos, the founder of EPS Momentum. We talked about looking at performance, starting the clock on the earnings date and looking at the post-earnings drift, post-earnings performance, post-earnings gaps, and just thinking about that and the momentum implications of that. And it really helped me solidify a lot of things that I've, have come to value in my own approach, which after an earnings related gap, while we may not have predicted that Enphase was going to gap higher, we can analyze what happened after. And some things to note from that earnings win, right? We had that big gap higher in earnings. That's been it. We have not made a higher high. We have not made a higher close since that earnings release. So I would say after that, the pullback to the 21-day EMA, the rally back up to retest that earnings, but not eclipse it. For me, that right there is the dynamic in Enphase that concerns me. And so what does not surprise me is from that moment, right, from that gap and fail, from the fact that we've failed to eclipse the gap high, and now we're making lower lows and lower highs, right? This is now a confirmed downtrend after that earnings gap. So what happens is this gap ends up being labeled what's called an exhaustion gap, which is after a big run higher, you have a gap, and it's like that last gap, right? What happened is we gapped higher, and then there were no more buyers, right? No one wanted to pay $50 a share for Enphase. And so everyone starts unwinding. And so you have selling pressure, but no buying power. And as a result, we're now in a confirmed downtrend phase. So that right there is the most concerning development for me with Enphase. Now we're making lower highs and lower lows. Now we've failed to hold all the moving averages. We actually finished below the 200-day moving average. Now the RSI is pushing below 40, and that happened over the last week. So at this point, I would say now you label it as a failed breakout above the 200-day moving average, a gap and fail pattern. That's why earnings-related gaps are really important to watch, particularly after, to see if additional buyers are willing to come in and pay that premium for the company. In the example of Enphase, no, that tells you there's a bunch of people unloading positions that they took on earlier and are thrilled to get out of the way. All right, we'll continue on with some of the awesome questions we've received from you guys here in the last week or two. I do want to give a shout out to one of our partners, EPS Momentum. I mentioned my interview with Alex Carto, who founded this firm. He's a former colleague of mine. We worked at Bloomberg together for a while. And Alex and his team have built a pretty fantastic tool called EPS Momentum. It combines price momentum, looking at average true range, looking at performance post earnings, looking at volume, but also earnings momentum, right? Looking at trends in earnings releases and earnings estimates, sort of forward-looking expectations for companies, and it combines the two of those with their proprietary models. So you can actually scan for stocks very easily, showing strong price and earnings momentum. And in my experience, and certainly in their work, that proves to be a really good list of stocks to be aware of. You can find more information about EPS Momentum at marketmisbehavior.com/EPS. If you use my link, you'll get 30% off a new account. I'd encourage you to check it out, see if it might be a tool that is worth adding to your arsenal. Next question, what do you think about the SEC's proposal to change earnings reporting from quarterly to semi-annual? How might that affect the market? Honestly, that has been rumored and debated for many, many years. I remember back in my Fidelity days, that's 2008 to 2016. I remember this coming. It was like a standard water cooler discussion about quarterly earnings and what that might mean. Would a change from quarterly to semi-annual be a good thing? I would argue, I would think generally yes. Where it would not be good is any sort of model that's based on earnings, right? Because quarterly earnings is sort of the lifeblood of that. And so the more data, the better. Having said that, it's been a long-standing challenge. I think that when you have a quarterly earnings release, company management is way too incentivized to optimize for a quarterly report and not for long. I mean, right? Company management should be willing to take chances in the short term for the opportunity for long-term growth and gains. But a quarterly earnings report and having to justify those once a quarter, a bad quarter, the stock can get dinged pretty bad, and all of a sudden the management looks incompetent. And so there's not, there's a mismatch between the incentives for company management to optimize to the quarter and what they should be doing. What's best for the shareholders is long-term growth of earnings and trajectory there. So generally, I would say that would be probably pretty encouraging. Other countries around the world do a semi-annual report. They seem to be able to figure out what companies are doing pretty well. So I don't think it would be a bad thing. I think what would probably happen if that would actually play out is that you would see companies probably offering guidance maybe a little more often in the interim between those 6 months. So I still think we would probably get decent color on earnings from company management, but the pace would be different. I just think it would move incentives for the management more in line with incentives for the shareholders. And I think that doesn't sound like a bad thing to me. Those are my takes. Great question. And I'd love to think about who would be great to bring on the podcast to talk through that in a little more detail. I'll think about that one. Someone that comes to mind, Nick Raish from Earnings Scout. Maybe I'll reach out to him and see if I can bring him on. Sorry, just writing that down. All right, next question. Yeah, this came from Thursday. Sorry about this. On Thursday's show, I did say I'm going to show the chart of Netflix, and then I didn't. I forgot to bucket it. I forgot to number it in the way that I do, so I know to show it on the show, and it was further down the list than I got to, so my bad. So yes, I did say on yesterday's show on the live stream I would show the Netflix chart. You're correct. I didn't. I forgot to. So let's do it now, shall we? I thought I had it up. I don't. Okay, so let's go to. I actually had it saved and everything. It was just down here at the bottom. So what I'd mentioned earlier in Thursday's episode was that out of all the Magnificent Seven stocks, Netflix looks the best. Now I will tell you that some other ones look kind of interesting. Like for example, Alphabet is I think at a really interesting point because we've broken down through the February and March lows. We did not break below the 200-day. We've now had a counter trend rally to that breakdown level. We're in the no man's land between the 50 and 200-day moving averages. I think that was what makes it kind of an interesting chart right now to see which way that's going to break, because one of these is going to give. We'll either break above the 50-day or the 200-day, but it's generally trending lower here in the last couple of months. Netflix is one of the few that's actually had an upside gap. Now, this is when the whole merger, acquisition with Warner Brothers Discovery went away, and as a result, Netflix had been beaten down for a little while and had a couple gaps up. What's interesting is if you look at the July or the June 2025 peak and the February 2026 low, 38.2% of the way up is right around $97, $98. That's actually right where we spiked up to. We got a little bit higher, up to $100 a share. We pulled back to the 21-day EMA. Now we're rotating higher. First Fibonacci level is usually important. $100 a share is a big round number. That's where we stalled out in March. I think Netflix is very close to a really strong upside validation. Not a lot of charts kind of look like this right now, so it's a little different in terms of its technical setup than other names that I could share with you. So I think a break above 100 would be bullish. Next upside objective, the 200-day moving average, obviously pretty vital. That's around 107 right now. So I think getting above 105 to 107 would be a nice upside follow through. But $100 a share, that's the peak to watch. The momentum generally has been much more improved. I like the fact that this pullback in mid-March was bought, and you see buyers coming in there. So I think the setup on Netflix out of all of them, pretty constructive. And I don't have a position specifically in Netflix, but if you would, I think there's what we call a natural stop. And what that means is a lot of times when you have a chart, you can immediately a good stop level kind of just jumps off the page at you. The 21-day EMA is always something I would watch, but this swing low, which is around 91, that's currently it's about 8 to 10% below Thursday's close. So taking a position on this upswing, using that swing low as a stop, you've limited your downside, but you're playing the potential upside. That's a pretty interesting risk reward, I would say, based on the setup and based on the improvement in Netflix. So I think compared to the other Magnificent Seven stocks, certainly one of the more encouraging. All right, last question, then we'll call it a holiday weekend here. Would it make sense to use RRGs on a universe or basket of stocks filtered by share price? For example, stocks under $10. That's a really interesting question. I mean, the short answer is for sure. That is actually a thing that we did back in the day, in my Fidelity days. We would often bring that up. Where do I have the sector? I thought I had the sector RRGs as a link on here. I must have moved that. Let's see, where did I put it? Yeah, so here's like the weekly RRG for the S&P sectors, and what you're basically saying is, can we do that on individual stocks? So the short answer is absolutely, right? Here's just an example using the XLC, which is the consumer discretionary sector. This is automatically putting the XLC as the benchmark. So this is looking at the consumer discretionary stocks versus the consumer discretionary benchmark. We could just do it versus the S&P. And that's kind of the idea. So what's interesting here is that we can see how these stocks as a basket are rotating around the benchmark in the middle here. And same methodology when we look at sectors, right? I mean, you've got the stocks kind of rotating on a relative basis around that benchmark. It's really helpful, and I've often, where we used to use this would take an index, take a benchmark, and put them in the RRG and see which stocks were looking good, which ones were not. We would take a portfolio. We would take one of the portfolios and one of the funds and put all the holdings in the RRG and look at where they were. And, again, ignore kind of the middle of the road stuff. Just focus on the outliers, focus on the things that were beaten down and improving, focus on the things that we owned that were rotating into the weakening quadrant. These would be areas where we would start to think about lightening up or underweighting. These are the areas we would start to think about increasing a position or starting to overweight, particularly if we're looking at like a benchmark. So 100%. Stock charts is limited a little bit. What you can do, hey, it's my show, so let me give it a shot here. What if I take? Let's see, what if I take one of my scans? I don't want to break this thing and bog it down. So let me see, let's look at, like dividend payers. Let's see what this looks like. Yes, this is like stocks with 200, it's a lot of names. So the problem with the RRG is if you have like a couple hundred names, it's just too much. Like you can't even use it, right? 32 names, this is better. So these are S&P 500 stocks that have a dividend yield above 5%. All right, so let's save it to a chart list. We'll say dividend payers. And sorry if I'm going too fast for you, rewind this and do it in slow motion. All right, here we go. So this is quickly on stock charts. Honestly, Optima is another platform that I use that does this pretty well. Does a pretty good job of incorporating the RRG into scans and screens. So those would be the two platforms I would be using to kind of pull this out. I'm going to go on like 4 weeks. Right. So now we're looking at S&P 500 members with a dividend yield above 5% and looking at them on a weekly RRG. And now we can see out of this basket of higher dividend paying companies, which ones are showing improving relative strength, which ones are starting to weaken, something like UPS, which ones are starting to improve, like KMB or Kraft Heinz or Skyworks, SWKS, going into the improving quadrant. So that's a long-winded way of saying, yeah, I think that would be a great way to do it. The whole point of the RRG for me, I often highlight it as a way of thinking of like top-down market conditions, which sectors are working, which sectors are not. But as a visualization, it is a fantastic way of taking a group of things, whether it's stocks or ETFs in a certain universe, and just putting them in a form. Instead of just looking at a big table of tickers with a bunch of data, I think this is a much more visually rich methodology of focusing on relative performance and focusing on which stocks are performing better than others and which ones are underperforming. And if we can focus in on areas of the market, on stocks starting to improve in whatever universe it is, I don't think that's a bad thing. This would never be the end of the process for me. As a final comment, this for me tells me what charts I'd want to look at further. From here, I'd want to look at the chart of KMB and VICI and Kraft Heinz and Skyworks and Campbell's and just see what the charts are telling me. But this helps me identify which charts may be most actionable right about now. Folks, awesome questions. Thank you all so much for tuning into my live stream this week. Thank you for asking these awesome questions over the last week or two. Please keep your awesome questions coming. During the live stream, you can ask on the fly. Anytime you watch a video on our YouTube channel, just use the comment section on our YouTube channel. We read every comment that comes in. Your questions are so helpful because they help me think about how I want to focus the content on my channel and in my upcoming shows. But it also gives us some great questions to go through every Friday when we have a little more time and space to dig into those thoughtful answers for you. Thank you all so much for tuning in. Having a wonderful, blessed holiday weekend. We will see you live on Monday. In the meantime, remember, it's always a good time to own good charts. Take care, folks.